and hi everybody. I hope everybody on the call today is actually a member of the single public service pension scheme. So that is the pension scheme available to staff joining the public sector after 2013. So this session is specifically targeted at members of the single public service pension scheme, and specifically the transfer facility which is available under the scheme. What we want to, I suppose, just cover off maybe is just a couple of basics under the scheme, and then I'll get into the specifics around the transfer in facility. So you're all members of the single public service pension scheme, which I said was available after the 1st of January 2013. This scheme is slightly different to the schemes that went prior to 2013, and the scheme operates on the basis of, referable amounts being banked each time a member is paid. The referable amounts are banked in the background and onto your record, and it's the accumulation then of those banked referable amounts that will derive your pension benefit at retirement. The single public service scheme is the scheme which is available to all public servants across the public service. So in other words, there would be no difference between the scheme that would be available in UCD to any of the civil service departments or any of the other universities in Ireland. So just to give you a little bit of background, I mentioned the referable amounts that would be banked for you on a monthly basis. So this is the formula that is given in the pension scheme rules that calculates the pension benefit. And you can see there it's a lovely complex formula with 0.58% of the pensionable remuneration up to a ceiling of 3.74 times the state pension, plus then 1.25% of the pensionable remuneration, which is in excess of 3.74 times the state pension contribution. So quite a mouthful there. Not something that you're expected to calculate for yourself. I'm going to show you an example of how that is calculated so that you can have a better sense of how that works. But in relation to the lump sum accrual, it's a simpler formula. 3.75% of your pensionable remuneration is what's set aside each time that you're paid from your UCD payroll. So to put that into some sort of context for you, if you had a salary of 50,000 on an annual basis and you were full-time, the way we would work out your referable amounts on an annual basis would be to take the 3.74 times the state pension, which is this figure here, 48456, multiplied by the accrual rate of 0.58%, and then take the excess pensionable remuneration over that 3.74 amount. So in other words, the 50,000 less the 48456 is this figure here, 1543, and we multiply that by 1.25%. So that would give us a referable amount for pension purposes of €300.34, okay? So that's just to illustrate how the calculation for pension referable amounts is done. I just wanted to show you this table here, which might explain, how it's accumulated and banked, and the possibility that it can be increased by CPI year on year. So we have been advised under the rules of the scheme, which, by the way, are given to us by the Department of Public Expenditure and Reform. So the department owned this scheme, and they would have derived the rules, and it would be the same rules applied to all public servants since the 1st of January 2013. And what they're saying is that there is a possibility that we can increase the benefits year on year through the minister's announcement in January each year. So for this example, we've just assumed a CPI rate of 1.7%, but equally the ministers could decide that the CPI in fact is 0. So if we look at year one here, we've got a referable amount which has been put aside based on the formula that we just saw there on the previous two slides of €319 per annum. So the €319 then in year two increases to 325 because the CPI has increased it by 1.7% in this example. You can see then in year two, it goes up again and so on all across the top line there. You can see that the year one referable amount is increasing each year. Year two, you can see that there's a new referable amount added and that increases then year on year and so on. And the accumulation of all these referable amounts for this example for 10 years results then in a pension of 3,455 euro. So that is an example of how it's banked and how it potentially can increase during that time. And the same thing would apply to the lump sum referable amounts. They would be banked and increased by the same CPI rate that would be announced by the ministers. So, you know, on a very basic level, you know that from the single pension scheme, you're going to have a pension, which is payable when you reach retirement for your lifetime in retirement, but also you'd be entitled to a lump sum, which is payable on the day of retirement. It's a one-off lump sum and is currently tax-free up to 200,000. So if all of that has kind of seemed like, you know, this is horrible pension formula, don't know how to work this out myself, you would be happy to know that there is an estimator tool available for all members of the single scheme, which has been provided by the Department of Public Expenditure and Reform, available through that link. All you need is your gross full-time equivalent salary, your work pattern. That means, are you working 100% of the time? Are you half time, where you'd be working 50%? You obviously know your age and the date that you joined the scheme. If you plug those 4 pieces of information into that estimator tool, it'll give you an idea of what pension and gratuity would be available to you then at the end of your time in the scheme. So those slides, I suppose, that I've just gone through is to give you a bit of context in terms of how the scheme works, very high level, you know, what you would, how your pension and your lump sum or gratuity amount is going to be calculated under the scheme. So recently enough, the department made a purchase and transfer facility available to all members under the single scheme. And what we're going to focus on today is the transfer facility. So this is the facility to purchase extra pension or lump sum referable amounts and have those added onto your record, which has the result of enhancing your benefits. And there are certain rules, you know, and conditions around the transfer facility, but what you can do is look at transferring pension benefits that you would have built up under other certain revenue approved retirement schemes or a PRSA and move those values into the single scheme and have that value then converted into extra pension and lump sum amounts. What you can't do is transfer from a pre-2013 public service pension scheme. So if you know, an example of that might be where you might even have been working in UCD, you know, 10 years ago, have contributed to the scheme, you left UCD and you went maybe into the private sector, and you find yourself now back in UCD at a later point. You cannot take that earlier pension benefit that you have built up in that previous public sector pension scheme and move it into the single scheme that you have now. And there, you know, that's nearly there to protect you yourself, because it probably wouldn't make sense to do that financially. The benefit that you'd have under the pre-2013 scheme would probably be far greater than what you would get if you moved it into the single scheme. So can't transfer from those pre-2013 arrangements. What you what a lot of people ask us actually about is whether they can move in benefits from the single scheme that they would have been in a previous public sector employer with. So if you had come to UCD directly from another university or another department or another public sector body, and you knew you were in the single scheme with that body. So you're literally just moving employer, but your pension scheme is staying the same. Well, in fact, you don't have to do anything to transfer that benefit with you because it is a single scheme, because it's the same scheme that you're remaining a member of. You don't do anything at this point to consolidate that. What happens is when you come to retirement or death, your final public sector employer will then coordinate and bring all of those different single scheme benefits together and organise that accumulation for you and pay one pension from the final employer. Another thing just to mention, because we do get a lot of employees who have worked in the UK and have built up pension benefits in the UK, particularly under the USS pension scheme, which is the University Superannuation Scheme in the UK. If you have a benefit in a UK scheme, you cannot move it across into this single scheme. And that's more to do with the UK approvals than it is to do with the single scheme not being able to take the value in. The UK scheme will be looking for certain approvals on the single scheme, which is not there, and therefore they wouldn't be inclined to make that transfer for you. So that slide, I suppose, just covers where you can and where you can't take a transfer from and bring it into the single scheme. So costing of it, what does it mean if you do have a scheme that you can transfer from? If you have a PRSA or a previous employer's pension scheme that you have a value sitting there in a policy or in a pension pot and you want to think about bringing it in under the single scheme, well, there is the first step would be for you to get your transfer value from your previous employment, your previous pension arrangement. You then go to this link on the single scheme website and you need 3 pieces of information. You need to know whether you're a standard member, your date of birth, and the value of the previous benefit. So I can tell you all that you're all standard members of the single public service pension scheme. If you were, you know, in the army or a firefighter or some scheme that is called a fast accrual scheme, that would be different, but we're all standard members in the UCD scheme. So you're going to pop that in, pop in your date of birth and the transfer value. And what this calculator does is based on a set of costing tables that the department have built into the calculator. It will tell you how much you can buy in terms of an extra pension or an extra lump sum amount under the single scheme. So in this case, this person has got 55,000 built up in a previous pension pot. And what the calculator is saying, well, you can buy an extra €2,221 worth of pension in the UCD scheme, or alternatively, you might want to enhance your lump sum benefit under the scheme, and in which case we'll actually give you 58,510 in return for the transfer value that you have available under the previous arrangement. So you can see there that in return for your 55,000 in your pension pot previously, you'd actually get a higher entitlement here under the single scheme in terms of the gratuity. Okay, so that's the cost. That's what we would look for you to be your first step. Once you have your transfer value, have a look at the calculator and decide, look, that's nowhere near what I would expect under the scheme, or yes, I'm interested in looking at that further and instigating a transfer. So there are certain conditions that would apply, and this is something that we'll check, when you have gone through that first step of doing the calculation, we can then look at the conditions and see if you can move forward with an actual transfer. And one of the first things we do check is that you have the capacity to complete the vesting period of 2 years. So in other words, if you're on a temporary contract of 1 year, you're not going to be able to participate in a transfer into the scheme at that point. Now, perhaps if you become permanent down the line, or in fact, if you were to have your temporary contract extended beyond the 2 years, yes, you can come back to us at that point and we can consider the transfer. We would always recommend that people take independent financial advice before entering into a contract for purchase or transfer to make sure that you're making the right decision. We can provide you with all the information that you need or that's available under the scheme, but ultimately we're not financial advisors, and that would be something that you would want to be assured of yourself before making the decision to transfer. What we also check before we let you proceed with the transfer is whether you're within revenue maximum benefits, and that there are just a couple of calculations that we do in the background before we can let you proceed. So, the revenue will only let you accumulate a certain amount of money in pension pots, and that includes your single public service pension scheme. We do those checks for you, and we'll let you know that if there's an issue with regard to moving a particular transfer value in. One other issue just to point out to you, if you found that you had a value in a previous pension pot that was a certain amount, and when we do the check for you in the pensions office, we find that that amount is limited in what you can transfer in. So for example, if you had 100,000 in a pension pot, we run the calculations and the limits, and we find actually you can only transfer in 70,000. Then a split transfer cannot occur. So your previous pension provider will not say, oh, that's okay, you can transfer 70,000 to UCD single scheme and you can leave the 30,000 here. That doesn't happen. Split transfers can't happen. So you would have to make the decision as to whether you wanted to proceed with the transfer of 100,000, knowing that you'd only get recognition for 70,000 in it. So that could be a result of the checks that we run on the limits. But again, it's something we'd make you aware of before a decision is being made. So they're the conditions for the transfer facility. As I said, you go into that tool on the single scheme website, you plug in your standard member, your date of birth and your transfer value. If the figures look attractive to you at that point, then you send that quote on to us in the pensions office in UCD, so pensions@ucd.ie. Include your name, personnel number and your date of birth, and we can then go ahead and run the limit calculations for you. If you at that point are thinking of transferring, we do need a letter of authorization from you, which would authorize us then to deal with your previous pension administrator or insurer or whatever is appropriate in terms of the particular pension arrangement that you're transferring from. I would have to say the single pension scheme website, the link that I have in there is absolutely excellent. And it is unusual to say that about a government website, but in fact, they've put a lot of work into the information that's available on that website for single scheme members like yourselves. And, there's some, I think, very well-written documents there, which are written in kind of layman's terms. There's at a glance guides, there's a very good booklet. So apart from the whole transfer facility, that single pension scheme website is a really good tool which is available to you as a single scheme member. We also have some supplementary information on transferring pension benefits, which is available on our own UCD Pensions website that you might want to have a look at. We then have specific information on the single scheme purchase facility, which is available at that link there. But all of that is available to you. You also have a very useful ESS record available to every single member in the single pension scheme, and that's available on ESS. So in the same place that you would go in and look at your payslip, you should have a pension record in there. You can go into that record and you can see what referable amounts have already been banked for you in UCD with regard to your UCD employment. So that gives you a sense of where you're at the minute, and kind of the pace or the amounts that are being banked for you on a regular basis. Any questions, anything that occurs to you in relation to your single scheme benefits, pensions@ucd.ie,